Hello friends. You are watching 3AZ Vision, an innovative distance learning channel. It is most important and desired, that if you are interested in improving your learnings, subscribe to our channel, and click on bell icon to get our future updates. Valuation of acquisitions and mergers. Here in this topic, we are exploring the three main ways of estimating the value of a target company, using assets-based, market-based, and cash-based models, and its related aspects. Therefore, we choose to discuss about 6 main factors relating to valuation of acquisition and mergers. That are, the overvaluation problem, principles of business valuation, valuation methods as assets-based models, market-based models, cash-based models, and valuation of high-growth startup. First of all, the overvaluation problem. When a company acquires another company, it will pay a premium above the current market value. Where this premium is excessive, this is known as overvaluation problem. Behavioral finance helps to why excessive bid premium are paid. So there are 3 main aspects involved in it, as what gives rise to the overvaluation problem, behavioral finance and overvaluation, and behavioral finance, other issues. Secondly, principle of business valuation. Acquisition may be valued using assets-based, market-based, or cash-based models. Whichever valuation method is used, the business risk and financial risk associated with the acquisition must be recognized. Therefore, keeping in view the valuation of target company, we discuss in detail all these valuation methods, that are, assets-based models, market-based models and cash-based models. Assets-based models. It involves 3 main methods for valuation of a target company as: Number 1. Book value plus. Book value or assets-based methods of company valuation are based on the statement of financial position as the starting point in the valuation process. Number 2. Calculating intangible value. Calculated intangible value, CIV, calculates an excess return on tangible assets. This figure is then used in determining the proportion of return attributable to intangible assets. Number 3. LEVS Knowledge Earning Method. LEVS Knowledge Earning Method involves separating the earnings that are deemed to come from intangible assets and capitalizing these earning. Market-based models. Market relative models may be on the price-earning ratio, which produces an earning-based valuation of shares. There are 3 main methods of valuing a target company as: Number 1. Price-earning methods. A price-earning ratio can be applied to valuing a takeover target, by taking the latest earnings of the target, and multiplying by an appropriate price-earning ratio. Number 2. Earning yield. Earning yield can be calculated as earning per share divided by share price. In other words, it is the reciprocal of the price-earning ratio, that is, 1 divided by earnings yield equals to price-earning ratio. Number 3. Market-to-book ratio. The market-to-book ratio assumes that there is a consistent relationship between market value and net book value. Cash-based models. The final set of valuation models are based on the concept of valuing a company, using its forecast cash flows discounted at a rate that reflects the company's business and financial risk. It involved 3 methods of valuation of a target company. Number 1. Dividend valuation model. This is based on the theory that an equilibrium price for any share or bond on a stock market is the future expected stream of income from the security discounted at a suitable cost of capital. Number 2. Free cash flow method. The free cash flow model is another, more sophisticated, cash flow valuation model. This model attempts to estimate the present value of the actual cash flow being generated by a company. Number 3. Adjusted present value. Using adjusted present value, an acquisition is valued by discounting the free cash flows to the firm by the ungeared cost of equity, and then adding the present value to the tax shield. Valuation of high-growth startups. Here are three main elements of valuation of high startups as: Number 1. Characteristics of high-growth startups. The valuation of startups presents a number of challenges for the methods that we considered so far due to their unique characteristics as: most startup typically have no track record, ongoing losses, few revenues, untested products, unknown market acceptance, unknown implementation timing, high development or infrastructure cost, and inexperienced management. Number 2. Projection economic performance. All valuation methods require reasonable projections to be made with regard to the key drivers of the business. The following steps should be undertaken with respect to the valuation of a high-growth startup company as: identifying the drivers, period of projection, forecasting growth. Number 3. Valuation method. Once growth rate have been estimated, the next step is to consider which is the most appropriate of the valuation approached. We have considered so far: net assets, market or discounted cash flows. At the end, we warm welcome your valuable comments to improve our learning levels. Thanks and goodbye.